All right, let's see what we got here today, folks. You want to stretch that, maybe even move that video panel up a little bit, Chris? If I increase the size of this window, I don't know whether you can. Yeah, there you go. I don't know whether you can pull that down. Oh, I guess you can't change it. Oh, well. Well, okay, maybe move it down a little bit. Maybe I'll give a little bit more room there. I just adjusted it. Maybe you need to just adjust it. Yeah, there you go. Something like that. Well, there you go. Looks like the announcement was just made. Look at the euro coming off. Holy shit. Boom. Stocks breaking. Gold tanking. Did they raise rates? Looks like it, eh? Hey, where did the room participants go? Isn't that weird how the Zoom is doing this now? Oh, I lost that window. Damn. I always like that window because I can see you. It's gone. Stupid Zoom. Wow, look at the US dollar reversing here. Were they actually thinking that they were going to lower rates? Jesus, look at that, man. That's some serious price volatility. Maybe what we should do is have the bigger picture chart handy. So, summary of the situation heading into the Fed, as I had sort of said in the public broadcast, I don't think it was really a good idea for anybody to make any grand conclusions about what was going to happen here until the Fed has actually done. So this is a half-hour chart now here. I still think that we're stuck in this massive megaphone for the US dollar. So we could literally be either way up top here or way down below here by the end of this conference today. I suppose it'll just be purely a function of what the dot plots are and the propensity for the Fed to talk about lowering interest rates, although I can't see how they could possibly lower rates. So on a half-hour basis, looks like all the currencies caught a bit of a bid here this morning, but they're giving that back. That was probably sort of like buy the rumor, and then maybe a US dollar weakness this morning was like sell the rumor. And now you're actually getting buy the news event in all the international currencies. Probably if you were looking for a trade, it looks like the Japanese yen just put in a nice little M top at some sort of key horizontal support and resistance level there. Franc looks toppy now. Canadian dollar. Actually, Canadian dollar has firmed up a couple pennies here recently. Does have room to move down. So the commodity currencies, not a big surprise. Commodities look pretty weak. Silver looks like it just broke some key support. And crude oil can't find a friend here of late. I think a lot of the reason why the crude market was getting bid up was people were wondering what the big sort of American response was going to be from these silly little Hutus of all people to be worried about in this world. And was Biden going to declare war on Iran? I don't know what he did. I don't know whether he actually did anything or not. But generally speaking, crude price has been heading lower here this morning. Stocks, they don't really like what they're seeing right out of the gate. I think we did have some earnings numbers come out of tech stocks overnight, and the street was not impressed with those numbers. So NASDAQ's been under a bit of pressure all day anyway. Looks like the Dow is starting to play a bit of catch up here. And the small cap stocks, they're not happy at all. right now on the day. We'll see. This is a half hour chart, 27 minutes. That's a Tesla half hour. So we'll see how these candles print. I would imagine, they always say don't trust the first hour following a Fed announcement. You might find that this whole damn thing reverses and looks the exact opposite an hour from now. So I wouldn't like draw any major conclusions while we're just sort of waiting for Jerry to take the stand. Looks like the bonds, probably they're interpreting the message from the Fed that they're probably not done yet. They still are worried about inflationary pressures, and so the bonds are coming off here a bit. Interest rates going back up. So that's sort of your bigger picture. Of course, with crypto, caught a bit of a bid here, better part of the morning. And we even saw things like now, I guess now dominance is coming back. Dominance was looking pretty weak there when there was talk the other day that there was going to be an ETH ETF. And the dominance just started to fall apart there. Dominance seems to be firming up here a bit back in Bitcoin's favor. You can see Bitcoin's kind of outperforming and dramatically outperforming Litecoin. I wonder if we get to the point where we actually substitute things like move Litecoin out and maybe even put Solana or Atom or one of those kind of names in Litecoin's place, because I don't know how relevant Litecoin still is. Mind you, I think if I'm not mistaken, Doge still validates its network based off of Litecoin. So I suppose if Alan has his druthers, Litecoin will still remain relevant. No, look at that. I'm constantly getting this message. No idea why the fuck this is happening. Anyway, you all got a nice little message about my IP address. Very bizarre. And it just, I don't know, it's some sort of fight between my laptop and my mainframe. Do I call it a mainframe? I'm not sure. Anyway, we were having a fun conversation about that in the daily brief. Looks like the yummies are coming off here. My hunch is you're probably seeing like bank stocks and stuff probably pulling back here. They're kind of probably hoping that maybe the Fed's obsession on raising interest rates was done, and I'm getting the impression that the market's being told they're not quite done yet. Might be interesting just for fun to pull up the Dow stocks. I think I have the Dow 30. Dow stocks. Let's see what we got here. 30-minute chart. So we won't do a Tesla 30-minute. We'll just do a 30-minute. Anyway, as you can see, we got all the colors of the rainbow on the screen here. This should be 30 stocks. Let's see, we got 4, 8, 11, 14, 18. Is my math right there? 18, 21, 25, 29. 1, 2, 3, 4, 5, 30. Yeah. So it might be interesting to circle back around, see how these guys did through the day. Who's the big winner? Who's the big loser? Looks like Boeing is enjoying a nice friendly market state here today. Chris, what do you think about Boeing jets these days? We're planning on taking a plane trip down to El Salvador to go kick the tires and see whether we want to relocate. Actually, I'm dropping Chris off there. He's staying.
No Boeing,
but
no
I get
Boeing,
the
please. Or no 737 Maxes. Yeah, no, none of those.
Dude, change the topic. Change the topic. I don't want to know. But if anything, if the stock's moving up, then maybe that means they pass some sort of inspection or something. Anyway, tongue in cheek. Microsoft, I noticed it was weird. I noticed before we got going today, Microsoft was up a big chunk, and then all of a sudden the market opened and Microsoft just fell out of bed. You can see Cisco, he's getting beat up here. Salesforce.com getting chomped. Honeywell's having a bit of a tough day after having a big day update yesterday. Chevron, isn't that interesting? Remember I was talking about how oil was looking awfully toppy there. Geez, Chevron looks awfully toppy. Look at this. WBA, what's that? Walgreens Boots. Enjoying a bit of a friendly market today. Nike, not enjoying a friendly market whatsoever. A little bit of trouble there. And Big Blue on its knees. So yeah, a lot of the tech proxies not looking very happy here today on the Dow. Anyway. So we're gonna get ready for Jerry. Macro picture, as you kind of saw, stock's not really that happy. Dow's heading lower. US dollar has now sort of come back to the flat line, and I might even argue that what you're probably gonna see here is there's probably a nice midpoint pivot on this megaphone. That's usually what happens. It's probably something like that. Well, maybe not that high. Yeah, maybe somewhere around there. But it might even be like off of that pivot. Is that the midpoint? It's pretty close. Interesting. Look at that M top developed right off of that level. So here we are basically, and if anything, this is the market saying, I don't know what the hell to do here. Do I go up? Do I go down? Might be interesting to see whether we actually hit Foggenbaums here on the US dollar. No, we didn't. So according to this market structure failure here, we should actually trade down to the bottom of the megaphone. That would be probably on Jerry saying things like, well, we're feeling like we've gotten in front of the inflation problem and clear skies ahead. And you probably see the US dollar come off. But I have been conjecturing with the TRIers of late. We are transitioning into a US dollar bull market. That should, and really it should have started in 2018 and it should have moved on into 2035. So at 2024, we're a little bit less than halfway through this cycle. I wouldn't be surprised 27, 28. There's some sort of massive, I wouldn't be surprised if there's a massive recession, maybe even Great Depression. And like China, Australia, China, Russia, China, anything that has anything to do with that China fiasco, bubble joke of a con job, that whole nonsense should completely unwind in that cycle. Ironically enough, the Americans should actually do relatively well through all that. But you'll probably see a quote unquote crash through that environment there as well. So anyway, keep that in mind. So interesting how there's our midpoint of the megaphone, and you can see how the US dollar index is just settling right in there, just waiting. What is Jerry going to say in his press conference? So zooming in on the shorter time frame, there is that US dollar index we were just looking at. There is the big up that we saw out of the US dollar on the knee-jerk reaction from the headline, the euro heading down. Swiss franc, British pound. Interesting how, and really, actually, my suggestion to all of you, if you want to watch for growth going forward, keep an eye on how Ethereum acts in here, because I think Ethereum, believe it or not, is actually like the ultimate leading indicator for growth of the tech space here going forward. I think it even leads like the NASDAQ. And the question I have going forward is, does Solana and all those kind of networks and stuff, do they join in on this? I think those are going to be the major growth drivers for our society this coming cycle. So anyway, keep your eyes peeled. You can see on that very short-term basis, stocks look like they're catching a bit of a bid again. So the knee-jerk reaction was, oh, puke out, sell everything. And now it kind of looks like things are stabilizing a little bit here. So, have we got Jerry up at the podium yet there, Chris? I don't know whether Suppose you could probably put the FOMC video link image if you want over top of this US dollar. And we will patiently wait for Jerry to take the stand and tell us what are us as good slaves. Oh, what's this? Who's this doofus? This is now the central bank trying to explain to you. Oh, sorry, go ahead, Chris. Chris is yeah. Well, that's the Rothschild saying, we're not such bad people after all. We actually do good for your society. Yeah, right. Um, as you can probably tell, I'm not really the biggest fan of these central banks. I think it's all, unfortunately, I suppose this is rhetoric, but it does pave the way for slavery of the human species, which is kind of sad, slightly. Any leaders here? It looks like China, even while everybody else is bouncing, China just can't catch a bid here. So I'll tell you, the fundamental situation in China looks really, really bad. In fact, in my entire lifetime, I've never seen the fundamental situation for my country look as bad as the situation is right now. I mean, it is really bad. You could very easily see China to turn into some sort of banana republic here. Keep in mind, all through the I remember specifically 1970s, a lot of sort of communist people in the United States trying to avoid the law would run to Mexico. Mexico was, considered a very like almost like first world. I had relatives that used to live down in Mexico and Mexico City and stuff. They live fairly nicely. And 1980s, Mexico just got completely decimated, currency collapsing, whole thing. No reason why that can't happen to China. It'd be interesting to see what China looks like by the end of this greed cycle. Could be pretty damn nasty up here. But anyway, I think I've told you, since the sickness, but even really since 2018, I believe Canada's a short. Anyway, that's here nor there. So it looks like stocks are trying to stabilize here. Interesting to see how Bitcoin can't seem to find a bid here. And there's our buddy Ethereum. If Ethereum's heading lower, then I would expect that the NASDAQ is probably also going to head lower here. So notice how the Ethereum chart, nice top, counter trend rally breakdown. You can see the NASDAQ, nice top, breakdown. A little bit of a counter trend rally, not too much. Kind of going sideways, but Ethereum seems to be leading the charge here lower. We'll see what happens there. Looks like the bonds are coming back here smartly, so that's encouraging. Wow, now there's an interesting image. You can see the energy market is trying to stabilize here nicely. That actually should help China, believe it or not. China, and actually, when I used to trade with the guys down in Chicago, they used to always say, if you want to know what the hell the Canadian dollar is going to do, just watch the natural gas price. But I don't know whether you noticed, anybody who's watching this, and if you watch this after the fact, last FOMC meeting, the energy markets were weak as hell through the entire FOMC event. And that actually let all these other markets, like all these stock markets, actually firm up and do well. Look at that. Crypto is leading the charge lower. Look at Ethereum puking out here. Woo-wee. Down she goes. I mean, I suppose while we're waiting for Jerry, we could take a quick boo at yield corn and see what the hell it's doing. Which screen was that? I wonder. So many screens. Over here, there's a Bitcoin. So as I had said in the free broadcast earlier this morning, I still think Bitcoin's basically trapped in a trading range. I really wouldn't interpret too much into this. If we do actually see this candle actually turn red and actually finish red, well, then we might have the makings of some sort of fractal failure here. For the time being, it's still pointing up. And on the lower time frames, look at this damn thing. It keeps disconnecting me everywhere. I still think that there's an inverted head and shoulders here trying to form. This is now off the daily chart. So if anything, ironically enough, coming out of this Fed meeting today, as you can kind of see here, I would not be surprised if we actually have to just do a little bit of backfilling here. So you can see, there is the fast moving average down there sitting at 42,000 on the corn. Don't be shocked if the corn has to come back here. Where are we now? 43,148. So you could see it lose $1,000 here, no problem. Anyway, hopefully you're enjoying the color commentary. Who we got in the house here today? We've got PE toilet water. Now, who the hell is that? Be interesting to see. Does anybody know on oh, look at that. We got 30 people watching. Hello, all you 30, 40 people. Who the hell is PE toilet water? Actually, that's a shout out to my father. Hey, Raris. Nice to see you, buddy. I haven't seen the Romanian contingent around in a bit. Anyway, nice to see you guys. Big Daddy Mac, D Mac, will make you. If George talking, shut the fuck up, Brian. That's how I'm gonna remember D Mac for the rest of my life. Big House says Fed's indicators, it is not ready to start cutting. Yeah, I mean, how the hell can you cut interest rates when the stock market's at all-time highs? There's no way in hell they're ever going to do that. That is just like the stupidest thing possible. That is just absolute idiocy. And that just goes to show how amateur a lot of people in the marketplace are right now. There is no way in hell the Fed is going to cut interest rates with the stock market at all-time highs. The whole point of them cutting interest rates is to save the economy and to save the market if the stock market crashes, because the stock market's your ultimate leading indicator for the economy. So if the stock market's booming to new highs, then that means that the economy is doing pretty damn well. So, yeah, I mean, and unfortunately, this is a lesson for everybody watching this video, especially if you're watching it for the first time. You never heard a clown like me barking away about the market. I mean, you have to understand that the 90% of the public, when they talk, the market will do literally the exact opposite. The market, let's see if any of you over on YouTube can finish this. And remember this for the rest of your lives. It doesn't matter whether it's Bitcoin or the stock market or, broiler chicken futures. The market is designed to take away as much money from as many people. How does the rest of that line go? Any of you in the room know? I hope you do. Hey, you better remember this for the rest of your lives. So, if the public is generally thinking down, then the market's probably going to go up. If the public is generally thinking up, then you better be careful. Thank you, Forest Real Estate Group, brokered by EXP. Man, that's a name. The market is designed to take away as much money from as many people as much of the time as possible. Remember that. Live it. Learn it. It is the way the market works. That's why all these idiots, and it's what makes me so angry at that Allen guy, is that he knows this. And that son of a bitch, actually, he goads the public on. He knows damn well how this game works. He's smart enough. And yet he doesn't act like a public steward. What does he do? He fucking stirs the pot. And he gets all the public, hey, buy Doge and you'll get rich, right? We're going to send Dogecoin to the moon or to Mars or whatever. Like, what the hell does that even mean? And half of what I try to do here and why I actually even started this website and this whole damn experience is I'm trying to help you people. And it makes me so angry the way the oligarchs in this stupid species don't help anybody. They actually make things a lot worse. And it really depresses me as a human being. I've often contemplated, but yeah, fuck it, maybe I should just screw these people over and join the oligarchs. And like when I was a prop firm trader guy, man, all those prop guys, they got so angry at me for leaving. Basically, I was, the prop firm that I used to work for, literally they had their trading desk was right between the S&P 500 pit and the Dow Jones futures pit, right on the CME. I mean, you literally could not get any closer to the center of the universe of capitalism. I mean, like you literally couldn't get any closer. And they were so angry at me when I went off and did this silly little adventure in crypto and Bitcoin. And my old boss, he likes to call Bitcoin beach balls. How are those beach balls doing? Oh, well, what can you do? All right, is Jerry taking the stand yet? Still nothing, eh? Time is it? 5 more minutes. All right, let's see what you guys are chiming in here in the well, did we lose somebody in the hangout here? I guess somebody bailed, eh? We got Ed B. Hello, Ed B. Glass Insights. Glass Insights says he's been around here literally since the beginning of time. And yet I have no idea who it is. That'd be funny if it turns out Glass Insights is like Da Vinci or something like that. That would be so funny. Still trying to figure out who you are. He won't tell me. Crazy internet aliases. Anyway. All right, so we're waiting. Interesting. Looks like this first euphoric period, you can start to see a little bit of a top now is coming in on the US dollar. Actually, this is a really good lesson for everybody. Why is the US dollar topping out where it is? You could make the argument, although I had to get rid of my drawing tool, so I guess I'm not allowed to draw here through this. Well, I was going to draw a nice little reload zone. Also, too, if you can just see this, notice this 3-bar fractal pattern. There's actually a very specific name that we give that 3-bar fractal pattern. The Americans, of course, they love that. So not a big surprise. You can see this 4-hour candle, the rally peak was right to that fractal fail level. So if you actually did want to short this and you wanted to join the level that you were supposed to be short from, that's it right there. So not a big surprise. We rallied right into that. And both the guys who did put this top in here and anybody who wanted to join that trade, you can see that they've started to come out of the woodwork and start to sell here. And probably what ends up happening is if this thing actually W's out and blasts through the top there, then that means this short trade idea, this top has been busted out. So it does make sense why the US dollar rallied to exactly where it did, and it stopped exactly where it did. And now we're sort of sitting here waiting, going, okay, we had the knee-jerk reaction. The Fed's not going to cut rates, and now let's go and listen to Jerry. And if Jerry sounds friendly and he's like, well, we're moving towards being more dovish, blah, 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 then this thing probably melts down. If he starts talking like, well, we got to be vigilant, and there are signs that inflation's starting to pick back up. Notice, look at the energy markets staying pretty firm in here. So if you see energy start to take off here, they always say energy is the leading component of the commodity cycle. And it's, think cost push, demand pull. Energy prices go up, that's increased cost to consumers. Consumers demand higher wages, and have to raise prices at the store to offset the rise in energy costs, and that's how you get the demand pull part of the inflation issue. So, really, we should all be watching energy prices really closely here. And the interesting thing with that is if we actually look at energy prices from sort of a higher perspective, although I don't know whether I have this on here. Energy prices actually look like they want to go up. So I wouldn't be surprised if the Fedsters see this and they're kind of like, we don't like that. What letter of the alphabet does that look like? And then you have like a W within a W. Did we maybe get a little ahead of ourselves here? I don't know. We'll see. But if this thing firms up and starts to turn back up, the indicators are not very happy right now. All right, so Brian, shut the fuck up. Let's get back to our screen. Which one was that? I don't think it was on here, was it? Yeah, here it is. All right, let's hear what Jerry's got to say here today. Can you post the link to that video conference somewhere, please, Chris? Because I can't hear what he's saying. Oh, okay. All right. Thank you. Everybody should give a shout out to Chris. Couldn't do this without him.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Gina Smiley from the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there,
Let's
you know
count how
that
many
you don't want to
Chappells.
cut interest rates without greater confidence that
Didn't hear
inflation
one from her.
is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against
US
the
dollar
sort of
did top.
solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay, so what are we looking for to get greater confidence? Let me say that we have confidence.
Euro flying.
We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and it has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good
So the
inflation
market
data.
likes what it's
The
hearing.
question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6-month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And
Here comes the bottom on Ethereum.
I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing, and that tells us that we are on, gives us confidence that we're on a path to a sustainable path down to 2% inflation.
Nick Timmeros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy as well into restrictive territory, what good reason is there to keep policy
Professor of
rates above 5%?
Economics.
Are you really going to learn more waiting 6 weeks versus 3 months from
Hello,
now?
bicycle.
That you have avoided those two risks.
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down, growth has been strong, the labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2%, so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our teal book, and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is, implicitly, is so in theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around for to see the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Howard.
Hi, thanks, Chair Powell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we've worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above, core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline. And the case is likely that it will continue to come down. So that's where it is. But we're wanting to see, more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
Yes, so let me say that we're not looking for that. It's not something we're looking for, but yes, if you think about, in the base case, the economy is performing well, the labor market remains strong. If we saw an unexpected weakening certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw
US dollar just getting taken
being
apart
stickier
here,
or higher, or those sorts of things would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down, that's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So,
look at that copper go.
We're not at a place of really working out those kinds of details because we weren't actively considering, moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes and the transcripts when they're released every 5 years. So
looks like
we
the
do
bottom
have a
and the
healthy,
long bond
set of
set
differences,
this
and I
whole
think that's
fire.
actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we
Small
do, they're
caps?
able to, for the most part, able to join in. To me, that's a well-functioning public
Yeah, cute
institution.
little W down there, eh?
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rents, so of course we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation, so the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time, but it may well have some more time to run. The supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Stocks didn't like that. Notice the bonds just went and topped out there.
You've said that you would know the neutral
Yeah,
rate by
Mr.
its
Leisman.
works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest-sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles and has brought that working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest-sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's of course, that it's not something you can identify with any precision, but a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate the neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will. But at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
That was interesting.
Thank you. Sorry. Thanks for taking the question, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market. I think you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic. Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market by many measures is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think, job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens, it's probably will take a couple of years to get all the way back. And that's okay. That's okay. But we do see, you saw today's ECI reading, the evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. Panic on the part of businesses, couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to what is still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And one great way to look at that is what's happening with wage increases. And you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months, but what's really going to shake out here? When we look back, what will we see?
Man, Ethereum didn't do anything here today.
Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
Whoa, what's that? So something happened on February 9th? Somebody want to look into that?
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE's been running at 1.5%. And there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years, so it's a good labor market. And we've seen inflation come down.
Copper just topped out.
So we've got 6 months of good inflation
Bond's
data and
getting
an
smoked
expectation
now.
that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. It's not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good.
Dow's going to break to new lows here.
Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, which we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward. Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this.
Mr. Chairman.
I've heard from some district Fed
Somebody in
presidents, is it,
the
your
Zoom
view,
just
a
said,
little
I don't
premature
think
to
anyone
rate
wants
cuts are right
sexy
around
time
the
with
corner?
Mr. Powell.
And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point you to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully.
Watch
as
the
we
long bond
consider
here.
when to begin to dial back the restrictive stance that we have in place. So
Bonds
if you
just
take
broke
that
to new lows.
the current context.
Gold broke to new
the
lows.
current context. We're going to be data dependent.
Dow
We're
broke
going to be
to
looking
new
at this meeting by
lows.
meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by
Woo,
the time
look
of the
at
March
that
meeting
US dollar go.
to identify March as the time to do that. But that's to be seen. So I wouldn't call
Euro breaking to new
when
lows.
when you ask me about in the near term, I'm hearing that as March. I would say I don't think that's
Toilet
probably
water
not the most
currency
likely
breaking
case
to
or
new
what we would
lows.
call the base case. Then your second question is
Is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data.
Ethereum never
The whole
got
thing is,
going,
this is gonna
breaking to
depend
new
on the data.
lows.
We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's
Somebody
really
didn't
going
like
to depend
something
on
I heard
how the
him
economy
say.
evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks
What
that
a
would cause
turn.
us to, if
Holy
they happened, that
moly.
would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things.
BTC
we're
dominance
just gonna
must be
reacting
dominating.
to the data. That's really the only way we can do this.
Victoria.
Nobody wants to have sex with Powell here
Hi,
today.
Victoria Guido with Politico. Could you talk a little bit more about productivity
Didn't even
growth?
say his
You know,
name.
you've mentioned multiple times about, you know, the level of wage growth that's consistent with 2% inflation. We've obviously
Victoria.
seen, you know, you were talking about ECI this morning.
No respect
in
for
which
the
it's
old
cooled
man.
a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute
Wow, look at
to
that US
productivity,
dollar
and
go.
do you
Holy
see
shit,
that
Muslim.
productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year, 23. I think we're basically in the throes of getting through the pandemic economy. And
Wow,
the question
what a
would be,
reversal.
What is it that has changed the, you know, the
Look at the
productivity
gold
tends to be
market
based
just
on,
puking out.
fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would
Notice
take,
they just
you know,
ran
people
the
talk about
stops.
AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see, work from home doesn't seem like it's a big productivity
Yeah,
increase.
took out
So
the high by like
AI, artificial intelligence,
0.8
generative, may
points.
be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but, you know, right now, I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force, and activity returning and supply chains getting fixed.
Right, so would that be behind why we've seen such strong growth, but we've also seen inflation fall, that maybe there's just a higher level of productivity
That's
right
one
now?
way to look at it, yeah.
Nancy. Hi, Chair Powell.
Nancy wants his
Marshall
baby.
with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
That's because they're not about
So when we
rising
think
houses,
about,
they're about dilution of the currency.
You know, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, you know, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. You know, we have a built-up set of cities, and you know, people are moving further and further out. So there hasn't been enough housing built, and these are not things that we have any tools to address. But you know, where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly, not most importantly, mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation, in the necessities of life, right away you're in trouble. Whereas even middle-class people have some scope to absorb higher costs. So we have to it's our job, it's what society has asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Fascinating to see the long bond telegraph this whole move down here.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed
She does
the
not want his
possibility
baby.
of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come.
You guys notice that the words that he speaks are put up on the
At this
screen
meeting,
before
we did
he
have some
speaks them?
discussion of the balance sheet, and we're planning to begin in-depth discussions
Something very suspicious
of
is
balance
going
sheet
on
issues
here.
at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them. But we're at the beginning of that process, I would say.
Quick follow-up, is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet runoff to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately, we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Why doesn't somebody act whether we're going to have a repeat of the 1940s late inflation problem?
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to 0, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to 0. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed up in the committee. We'll get into all of the issues that will be arising over the course of the next, let's say, year or so.
Greg.
Thanks, Greg Robb from Market Watch. Chair Powell, I want to change gears a little bit.
A lot of the men want to have his baby.
Presidential primary campaign that's been going on for the last 9 months or so. Your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a 3rd term. So I wanted to give you a chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months, and you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten.
All right, looks like here they come
as I mentioned,
again.
we're going to be reacting to the data, If we get very strong inflation data and it kicks back up, then we'll go
Bottom
slower or
gold.
later or both. If we got really
Bottom in
good
the NASDAQ.
inflation data
Notice
soon,
how
that would matter
the
for both
Ethereum
the-
has
that
been
would
actually
tell us
leading the market
that,
lower here.
That we could go sooner and perhaps go faster. So we're just going to be, but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that inflation were the 6-month inflation numbers, which are very close to 2, were in PCE world. If we came to if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point. Is we're trying to get comfortable and gain confidence that inflation is on a sustainable path down to 2% or toward 2%.
Daniel.
Hi, Chair Powell. Daniel Davis, France Press. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years, but nonetheless that's been the case, and we've asked ourselves why that is, and one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Thank you for taking our questions. Brian Mena, CNN Business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data are subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy, and I always feel like I spent most of my life in the private sector looking at companies, individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone. That in all their districts, they're talking to, not just the business community, but the educational, medical, nonprofit community. They have arms into all of that. And so when they come back, that's what goes into the beige book. But they come back, and what each Reserve Bank president does is, during the Outlook go-around, they'll say, in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from their district?
Yes, I mean, if you look back at the last, not this beige book, but the one before, it was more, there was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing, not in every district, and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what
Notice the whole market just had the wind knocked out of it here, eh?
Thank you, sir. Jeff Cox from
Everything's
CNBC.com.
just
Just kind
stopped.
of looking to put it all together. You had talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now and that inflation could come back at some point?
I'm not so worried about that. It's, again, we've had inflation come down without a slow economy and without, important increases in unemployment. And there's no reason why we should want to get in the way of that process if it's going to continue. So I am,
Cheers, Nick.
I think declining inflation, continued declines in inflation, are really the main thing we're looking at. Of course, we want the labor market to remain strong, too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
And that's all she wrote. Well, there you go, folks. Maybe you can minimize that, Chris, and we'll just do a brief overview of what we heard and call it a day. Cotter's taken off. Anyway, nice chatting with you guys in the room here today. Appreciate it. So what the hell did we just hear? The one thing that did surprise me out of all of this is you notice that when the whole damn market started to lift there and everything started to rally, Ethereum didn't move an inch. And remember my comments from earlier on, I said I like using Ethereum as sort of your growth proxy. And then when things topped out and they all started to puke out, Ethereum just busted down to new lows and is still sitting lower now. So I do find that fascinating. As a challenge for all of you, I would suggest that you watch how Ethereum acts through these FOMC events. Probably, an absolutely stellar example of why it is we don't want to trust the first hour following that Fed announcement, because I'm sure there were a bunch of people on all of these W's that came in right across the board. They were all like, this is it. It's a new bull market. We're all going to get rich. And wow, did they ever get bitch slapped here. Be interesting to see what was the comment in particular that actually freaked the market out. And I think, if I'm not mistaken, he was saying the whole market turned over when somebody asked, well, what happens if inflation numbers run below 2% for an extended period of time? Would that change your outlook or your thinking? And he was like, no, actually, it'll be perfectly fine if inflation numbers, in fact, I think he was even sort of suggesting that if inflation numbers did actually print lower than the 2%, and I think he's specifically talking about the PCE that they like to follow, that he would be fine with that, and that he would actually expect that to happen. And as soon as I heard that, the whole damn market just puked out. There was something that he said in there. Somebody in the Zoom call said, wow, the algos did not like that. And they all just went into overdrive on the sell side. Interesting to see the yen here already starting to push lower. That might turn into a nice bear A, B, C, D. They always say currencies lead everything, by the way. Interesting to see how the crypto market is catching a bit of a bid coming out the other side. I'll tell you, I was a little surprised to see the way the US dollar had topped out there. That was like absolute textbook move by the US dollar. What I wanted to show you earlier, I guess I can show you now, is this was a pretty textbook move right into a reload short zone. Good old mountain man there. And then you could probably also say that was like beautiful reload zone just off of that range there. And I had made reference earlier, I had said that this 3-bar fractal pattern I thought was a pretty important level. So the market went up, it tagged that, like I said, into reload short zones. Then it backed away, and then all of a sudden, just the market just boomed higher. And fascinating, look where they stopped the rally, right? The top of that empire was 103.683, and the rally peak was to 103.691. So I think what happened there was the algos probably, in my opinion, is they kind of sniffed out that the entire world was short, and then they went after the stops. And I think that's what that move was just nothing more than there was a bunch of stops up top there. People don't primarily trade the US dollar index. What they do is they trade things like the euro. So you could make an argument that, there was probably a bunch of stops against, this low right here. That's probably that high on the US dollar. So notice they went through that level, right? Rang the stops, ding, 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 ding. Then there's like a vacuum. And you heard me even say, I noticed that there was just basically a vacuum. The whole market just stopped as soon as that event happened. And the last like 10, 15 minutes of his talk there, the market just didn't budge an inch. But look at what's happening now. Remember we said that the yen was potentially putting in a bear ABCD. Now you can see these European currencies, which I do think have a major problem with inflation and have also a major problem with growth. I would say that if there's any place of the market that's vulnerable, it's Europe and these European currencies. And interesting to see, British pound is already now confirmed that AB equals CD. And now you got a little bit of an M coming in there on the euro currency itself. So there's the Japanese yen. So yen has already confirmed that ABCD. Boom, 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 boom. So probably heading back down against these lows. And of course, the good old commodity currencies. This is the one part of the market you want to avoid like the plague for like the next probably 10, 15 years. On my public broadcast and also on my rants on the site, of course, you hear me laying into the idiot that's running our country right now. I will tell you, from a guy who's worked in the market for I literally got my first job in the market in 1988. So comparatively speaking, we are in 1984, sort of cycle-wise comparison. I've been working in the market a long, long time. I have never seen the fundamental situation for both the commodity currencies as bad as the situation is now. Australian dollar, Canadian dollar. And the Aussies used to boast, all through the latter part of the 2010s, early 2020, they hadn't had a recession in like 20 years and they were bulletproof. And now, unfortunately, they always say, careful what you wish for, you might just get it good and hard. They say, things like, the mighty, they fall the hardest, right? The bigger they are, the harder they fall. The egos coming out of these countries, the whole MMT nonsense and all that. I have a feeling these countries could be in big, big trouble going forward, which is such a shame. I mean, this is my country. You don't really like to be publicly branded as a bear of your country, but Gotta say, the fundamentals just look absolutely horrific for Canada right now. Anyway, it is what it is. Only time will tell. So I don't know who we got here. Anybody feel like throwing in their 2 cents? Cotter, you're always good for a laugh. You feel like chiming in here? What did you hear today? Anything jump out at you? You feel like chatting?
Oh, hold on, let me grab my microphone.
There he is. Crash bang. He's got to kick the chickens out of the fucking coop.
Oh, they're all locked up. It's been a very boring winter here, though. I didn't hear anything in particular that he said, but charting wise, I see a lot of consolidations going on the stock market indexes. We could get a little more down, but I don't think we're going to go hit, for instance, let me bring up what I was just looking at on the NASDAQ, actually. I think it's going to go up some more, but not, maybe give someone a little bit of scare, but I see support at, let me look at the Qs. Actually, I have that charted better. I see support from 414 and at the lowest 403. I don't think we're going to go hit 400. I think we're going back up, but maybe
all
not
right.
today.
Yeah, your daily chart here clearly a bull. And until we actually start emming out here, it's tough to make the bear case. Probably, I guess the easiest way to look at that is maybe we just went too far too fast. I don't know.
Yeah, just needs a little time to digest it, because I still have a lot of targets to the upside, not like way to the upside in the near future, but I don't see any reason that I want to drop what I'm holding in the Qs at all at the moment. And I don't have a lot in there, but if it comes down and hits and shows me a W, I have a 2618 to the downside of like 415 and at the most, which
Was
takes
that
us
on the
down to
QQQs?
404. Yeah, on the Qs.
Let's see what the hell you're seeing over there. Yeah, just use this chart. QQQ, yeah. I mean, it's not a bear, and we just made new highs. I guess this is the whole point.
Yeah.
I mean, I don't know how the Fed can lower interest rates with the stock market making new highs.
Yeah, I mean, that whole area of your Brian's bias MAs is support for me. So if we get a little W, I might double down here a bit.
Chaos theory 2.618 basically is a Wyckoff check. All these gaps, they probably need filling in, right? So,
yeah, well, maybe to that 4669, but I bet that if it did that, it'd be a wick and back up we go.
Yeah.
That's right at the 50-day also.
Yeah, I mean, you do have a cute little double top here working. So maybe we got a short-term top. Also, too, probably January barometer. Noticed, January right out of the gate was actually pretty soft. So I wonder if they're kind of thinking that this first quarter needs to be a bit painful here. But on balance, it's awfully tough to get bearish of that chart just yet. I guess pullbacks are buying opportunities, eh? I do like maybe coming into Collins zone here. Good old pump chaser. That's not what I want. Where's pump chaser? Where is he? There he is. 38.2. Look at that. It's right on those lows. So I like the idea of a nice pullback here. Test like sub 400. I could see that. And that would be about a 5% correction from, I guess from the peak. That would be about a 7-8% correction. I could see that.
That would be a setup for head and shoulders, but it also could be a fake out head and shoulders too,
Yeah, well, I could see, and quite often we do see this happen, right? You carve out a really pretty head and shoulders, and then at the end of it, and it literally can go either direction. Basically, it all depends on which way sort of the karmic winds blow. And you might find that this actually turns into a huge move to the upside. I've seen that happen plenty of times. But
So
I do like the idea of a consolidation here the first half of the year. I do like that thinking.
The only argument I'd have against my thoughts on that is the market might want its rate cuts, and historically, if you look back at rate cuts, you usually get a dive in the market before they cut and then a little bit further dive. So, I mean, I'm always thinking of that potential as well. So if the market dives further than anybody thinks,
Right.
then
Well,
maybe
and
we
that's
get
what
rate
leads me
cuts
to
in
believe.
February.
That's what leads me to believe that what was that China ETF we were following? FXY or something like that? No.
The only one I have is K-Web and K-Set.
China, China, don't get China. There we are, FXI. Oh, that's close. So really the $64,000 question is, if this thing pukes out, and I mean, it just looks like a train wreck here. There's no sign of a bottom at all. But if this thing absolutely pukes out, and like Evergrande and all that kind of stuff going into receivership now, maybe that forces the hand, right? Maybe this market breaking causes this correction, and we get like a 7-8% correction, and then that forces the hand of the Fed when they say, all right, fine, we'll give you a 1/4 point rate cut just to make you happy. I could see that. That wouldn't surprise me. Anyway, only time will tell, as they say. Be interesting to draw a channel off of this entire range. Sure looks to me like maybe there to there to there. Oh, look at that. Nice. So I think that's kind of what's going on here. Notice how we played at that midpoint channel. We had to lose it and come all the way back down. I get the feeling that that's our trading range for the time being. Anyway, we'll see. Do you buy into any of Larry Williams' idea? First 6 months of a presidential re-election year should be soft.
Yeah, well, I've been watching his videos, and I can definitely see that. Question is, you can't exactly tell when all these decisions are going to be made. So that's we were just talking about. You could get a deeper retrace before we get a cut, but if we get a cut, I would see a further retrace at the end of that cut. But really depends on what we see between this week and next week, I think.
Yeah. Yeah, interesting. In fact, this is even now creating what they call an island. So that's kind of interesting. This is basically an island top up here. You don't see that every day. Which does mean we're probably going to be back
daily,
here at
there's
some point.
no divergences on the daily at all, as far as the MACD, but the RSI, looking at the daily, has interesting little M's that it puts in, which were
divs anywhere? Wow, Willie sure is stupid.
Yeah, and Willie's
stupid.
Whoa,
look at that div. Oh, wow, that's huge. Isn't that interesting?
But then you conquered it back on the other side and got a new high, so you're not in a div anymore.
Yeah.
But you do have an M in the RSI, which I like for,
Wow, look at that weekly chart, though. Ooh, boy. Does that ever look dangerous? Anyway. So, yeah, lots of... this market needs some time to clean itself up. I think that's...
Hey, look at that on the 3-day, because the MACD definitely is showing some div, and you've got a double top on the RSI, and you've got a 3-bar fractal building on the QQQs.
Yeah. Well, and if that 3-bar fractal does confirm, then that would confirm the island top, and you probably have like gap and go kind of stuff. Yeah. I mean, the problem here is it's awfully difficult to justify buying up there, right?
Yeah, I'm not buying anything right here. I want to see W's on time frames and just a volume spike, and then I would jump in, because really my target for this move was between 435 to 448. Doesn't mean I'm going to get it, but that's what my targets were.
Yeah, I suppose you could make the argument like the stock market bottomed last December and then into the first quarter. Had a big run up. I think you can see the same thing in Bitcoin. So, same comment that I make with the public. I can't justify buying Bitcoin here. So,
I'm not big into anything. I've cash on the sidelines, and I'm just like to go have our vacation and
Yeah, damn straight, right? I want to get to know the El Salvadorian female population.
Although the presidential election's on the 4th, and if Bukele loses, I might not come. Because that means the communists just took over.
Oh, interesting. Wow. So Chris and I are starting the adventure on the 6th. That'll make an interesting Coinigy show on the 7th. My hunch is he does win. I would be shocked. I mean, like you can see the whole sort of inertia of the world. Everything is shifting from left back to right now. So
Yeah.
I would be absolutely shocked if the socialists came back into power. But anyway,
Well,
if he does
night-
get, sorry?
I was just gonna say, TBG said last night that that he went out on another real estate tour to look at real estate, and the real estate agent, hold on, he said a couple of things. One is that looks like Google's moving a headquarters in there. They've been big because of their volcano power for for not just Bitcoin mining, but for big data centers and cheap electricity for big data centers.
Yeah.
And then there was another thing he told me too. Let me see if I can find that really quick. Let's see, TBG. And he said, he's also said Binance is relocating.
Binance is
Plus a few
relocating to El Salvador. Oh, goodness.
Yeah, plus a few airlines.
There you go. There's a cherry on the cake. Chris, you got to go get. In fact, actually, we get our crypto data now from CoinMarketCap, their API, and they're owned by Binance. So maybe there's some sort of and one of the guys who's a principal there at that CoinMarketCap Binance firm is actually a TRIer. So yeah, it's a small world.
Yeah.
All right, folks. Well, I think we'll probably end the broadcast on that. Wow, huge head fake through that Fed announcement. That, if anything, Chris, maybe you can tag this video. We should have this in the library as a really, really good illustration of why you can't trust that first hour following that Fed announcement. I think everybody and their brother, as we were moving through that conference, was convinced, including myself. I mean, it sure looked like the whole damn market was about to roll over here. Was convinced that the U.S. dollar was about to puke out and everything. All the risk assets were about to go to the moon. And then all of a sudden, out of nowhere, boom, massive reversal. And interesting, you can see U.S. dollar is actually extending its gains here. And I have to say, listening to Powell there, I didn't hear any talk about the Americans lowering interest rates anytime soon. It's really just a question of how long are they going to keep rates up here. And in my history in the market, my experience, the Fed will only cut rates if they have to. They would actually prefer to keep interest rates higher and be completely in front of the inflation curve. So having said that, I think that the Europeans, with their growth prospects, Germany technically is in recession now. You listen to Sjord, poor old Sjord over there in Netherlands, they're dying 1,000 deaths, new taxes every bloody day. The economic prospects for Europe right now, I think, are slim. Whereas the U.S. economy is booming now. Be interesting to get more anecdotal sort of talk from our Americans about what the economic situation is in the various regions there down there. And of course, I'll be on the ground from the 6th. I'll be in Seattle, and on the 7th we'll be in Portland, doing the Coinigy show from probably even from the University of Oregon campus. No association with them, but I think that's where Joe wants to do it. Then we'll be working our way down to San Francisco, Sacramento, maybe over the weekend. Then we're going to be hitting LA. So we're going to be doing basically the whole West Coast here. So if you happen to be on the West Coast, maybe drop us a line at TRI. And keep in mind, for whatever it's worth, we might as well throw in a shameless plug. You can come and join TRI for free, a 30-day trial, kick the tires. learn a little bit about what it is we do and how we do it on a daily basis. Interesting. There's a picture that doesn't load there. Unfortunately, you have missed the new school term. It just started, so we won't be doing any school intake now. But if you're interested, we'll have a new education program term start in April, May. Maybe consider giving that a thought if you want to learn how to run a small business of trading. Okay, I think we'll leave it at that. Thank you very much, Chris. Chris, you still with us, buddy? I think he's still here. There he is. Thank you very much. Awesome job as always. Everybody give a big shout out for Chris, sort of running the whole show from back end. Appreciate it. Julian will be on the Daily Brief tomorrow. So enjoy the baby powder report. I guess the next time I'll talk with all you guys will be Friday. And then, of course, we'll have our free broadcast on Sunday, the Broiler Chicken Show. So, all right. Have yourselves a great day. PMA for the win. All the best. Hugs and kisses. Remember what your number one job is. Don't take no wooden nickels. And bye for now.